Hey everyone, and welcome back to the Babalian Money Show. Today, we're diving deep into the wisdom of a true investing legend, the Oracle of Omaha himself, Warren Buffett. For decades, investors have hung on his every word, trying to decode the secrets to his phenomenal success. And while many people think his strategies are complex, the core of his philosophy is actually surprisingly simple and accessible to all of us. So, if you've ever wondered how to build long-term wealth the Buffett way, you're in the right place. We're going to break down his most powerful principles, piece by piece, and show you how you can apply them to your own investment journey. Before we get started, a quick reminder, I'm not a financial advisor, and this video is for educational and entertainment purposes only. Always do your own research and consider consulting with a professional before making any investment decisions. Your financial situation is unique, and it deserves personalized advice. Now, with that out of the way, let's get into the mind of the master. The first, and arguably most famous, piece of advice from Buffett is, rule number 1, never lose money. Rule number 2, never forget rule number 1. Now this sounds simple, almost too simple. Does it mean you should never see a stock go down? Not at all. Buffett himself has seen his investments fluctuate. What he's really talking about is the permanent loss of capital. He emphasizes avoiding speculative bets and focusing on preventing catastrophic errors that can wipe out your portfolio. This is about risk management at its core. It's a mindset shift from chasing quick, risky gains to prioritizing the preservation of your hard-earned money. Think of it like a ship's captain. The first priority is to get to the destination as fast as possible by sailing through a hurricane. It's to ensure the ship doesn't sink. Once you've secured the ship, then you can focus on reaching your destination efficiently. So, how do you avoid losing money? This leads us directly to Buffett's second major principle, understand what you own. He famously said, risk comes from not knowing what you're doing. He doesn't invest in things he doesn't understand. Back in the dot-com bubble of the late 90s, everyone was piling into tech stocks, but Buffett largely stayed on the sidelines. People called him old-fashioned, but he simply said he didn't understand their business models or how they could be valued. And when that bubble burst, his discipline paid off immensely. This is the concept of the circle of competence. Everyone has areas they understand well, whether it's technology, retail, banking, or healthcare. Maybe from your job or a personal hobby. Buffett's advice is to stick within that circle. Don't invest in a biotech company just because you heard a hot tip if you don't understand what a clinical trial pipeline even is. Instead, focus on businesses whose products, services, and competitive advantages you can clearly explain. When you truly understand a business, you're in a much better position to judge its long-term prospects and whether its current stock price is a bargain or a trap. This brings us to the next crucial point. Price is what you pay. Value is what you get. This is the cornerstone of value investing, a philosophy Buffett learned from his mentor, Benjamin Graham. Most people get caught up in the daily wiggles of a stock price. They see a stock going up and they get FOM, the fear of missing out, and they buy high. Then, when the stock goes down, they panic and sell low. Buffett does the exact opposite. He's not interested in the stock's price chart. He's interested in the underlying value of the business. He calculates what he believes a company is intrinsically worth based on its assets, earnings power, and future growth prospects. Then, he waits. He waits patiently for the market to offer him that business at a significant discount to its intrinsic value. He calls this buying with a margin of safety. Imagine you think a company is worth $100 per share. You wouldn't buy it at $99. But what if the market, in a moment of panic, offers it to you for $60? That $40 difference is your margin of safety. It's your buffer against bad luck, miscalculations, or unforeseen problems. As Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that word, wonderful, is key. Buffett isn't just a bargain hunter looking for cheap, broken companies. He's looking for wonderful businesses. But what makes a business wonderful in his eyes? It comes down to something he calls a durable competitive advantage, or an economic moat. Just like a medieval castle had a moat to protect it from invaders, a great company has something that protects it from competition. This could be a powerful brand name, like Coca-Cola. It could be a patent, a low-cost production advantage, or a network effect, where the service becomes more valuable as more people use it, like with American Express. These moats allow a company to generate high returns on capital and fend off competitors for years, even decades. When you find a company with a wide, sustainable moat, you don't have to worry as much about the day-to-day competition. You can be confident that the business will continue to thrive and grow over the long term, compounding your wealth along with it. Which leads us to perhaps the most powerful force in Buffett's toolkit: time. His favorite holding period is forever. This is a massive departure from the high-frequency trading and short-term speculation that dominates the market today. Buffett isn't a trader. He's a business owner. When he buys a stock, he's not buying a lottery ticket that he hopes to flip next week. He's buying a piece of a business that he wants to own for a very long time. He lets the power of compounding do the heavy lifting. Think about it. If you earn a 10% return, your money doubles in about 7 years. But if you keep it invested, that doubled money then starts earning its own 10% return. It's a snowball effect. As Buffett says, someone's sitting in the shade today because someone planted a tree a long time ago. Long term. Investing requires patience. It means not getting spooked by market downturns. In fact, Buffett sees market crashes not as a crisis, but as an opportunity to buy more of those wonderful companies at even cheaper prices. He advises us to be fearful when others are greedy, and greedy when others are fearful. When the market is in a panic, that's your chance to go shopping. Another fascinating aspect of Buffett's strategy is his focus. His company, Berkshire Hathaway, holds a relatively concentrated portfolio. He once said that diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Now, this is advanced advice. For most of us, especially when we're starting out, a well-diversified portfolio through low-cost index funds is the safest and most recommended path. But Buffett's point is that if you've done the hard work, if you've found a handful of truly exceptional businesses that you understand deeply and that are trading at a discount, it makes sense to make significant bets on them. Instead of spreading your money thinly across 50 or 100 average companies, you concentrate your capital in your 5 to 10 best ideas. This approach increases risk if you're wrong, but it dramatically increases your potential returns if you're right. It forces you to be highly selective and to have extreme conviction in your investment thesis. So let's recap these golden rules. First, prioritize not losing money. Protect your capital above all else. Second, operate within your circle of competence. Invest only in what you truly understand. Third, always distinguish between price and value and demand a margin of safety. Buy wonderful businesses when they go on sale. Fourth, look for companies with durable competitive advantages or wide economic moats that can protect them for the long haul. And fifth, think long term. Let the magic of compounding work for you and view market volatility as an opportunity, not a threat. Putting it all together, Buffett's philosophy isn't about complex algorithms or secret formulas. It's a business-like approach to investing built on discipline, patience, and a relentless focus on quality and value. It's about ignoring the noise of the market and focusing on the fundamentals of the businesses you own. It's a timeless strategy that has proven itself over and over again, through bull markets and bear markets, through recessions and booms. It's a way of thinking that can help you not just become a better investor, but also a smarter consumer and a more rational thinker in all areas of life. I hope breaking down these principles has been helpful and gives you a new lens through which to view your own investment strategy. The path to building wealth isn't a sprint, it's a marathon. And by following in the footsteps of a legend like Warren Buffett, you can build a solid foundation for your financial future. What's your favorite piece of Buffett advice? Let me know down in the comments below. I love reading your thoughts and starting a conversation. Thanks so much for spending your time with me today on the Babalian Money Show. If you got any value from this video, please give it a thumbs up. It really helps the channel reach more people. And if you haven't already, make sure to hit that subscribe button and ring the notification bell so you don't miss our next video. We've got a lot more great content coming your way. Until next time, invest wisely and stay patient.